Welcome back to the deep dive. Today, we are making a hard pivot. We are leaving the hype cycle completely in the rearview mirror. So I want you to forget about digital art for a second. We aren't talking about meme coins with dogs on them. We are walking into the boardroom. We're talking about the serious, buttoned-up world of global finance. We're talking trillions with a T of dollars in bonds, real estate, and repo markets, moving on to the blockchain.
It's a massive shift. I mean, for a long time, people looked at this technology as this, experimental fringe thing. But what we're seeing now is the transition from the, let's call it the internet phase, where everyone is just trying to break things into the industrial phase.
Exactly. And to guide us through this, we aren't relying on Twitter threads. We have a stack of heavy-hitting documents on the desk today. We're working off the November 2025 final report from the board of IOSCO, that's the International Organization of Securities Commissions.
And that is a huge deal. I mean, IOSCO represents the global standard setters for securities markets. When they publish a final report on the tokenization of financial assets, it's a signal. It means the regulators aren't just watching from the sidelines anymore. They are actively defining the rules of the road.
We've also got industry intelligence from RWA.io, that stands for Real World Assets, and the latest regulatory updates from the U.S. President's Working Group. So the mission for this deep dive is pretty specific. We want to unpack why the major financial institutions are even doing this. Why take a boring old treasury bill and turn it into a digital token? And how does it actually work? Because, spoiler alert, the sources suggest it's not always how you think, and of course, what are the risks?
Precisely. Because when you start messing with the plumbing of the global economy, things can get sticky fast. And I think the best place to start is with a bit of a reality check. You hear all these headlines about a financial revolution. But if you actually read the IOSCO findings, they aren't describing a revolution at all. They call it an incremental evolution.
Okay, let's unpack that, because evolution sounds a lot slower than revolution. First off, we need a clean definition. When IOSCO says tokenization, what are we actually talking about?
They define it quite simply. It's the creation, issuance, or representation of assets on a digital ledger. We aren't talking about creating new cryptocurrencies. We're talking about real-world assets, RWAs. Taking a bond, a share in a fund, maybe a piece of commercial real estate, and representing that ownership as a token.
Right. And the sales pitch for this has always been pretty seductive. I've heard the buzzwords for years. Fractionalization, democratization, the idea that I could buy, say, 1/100th of a skyscraper in Manhattan.
Is the marketing pitch, yes. Fractionalization is a big part of the narrative. But if you look at what the banks are really excited about, it's less about that and more about efficiency. They care about programmability and atomic settlement.
Atomic settlement. That sounds like something out of a sci-fi movie.
It does, doesn't it? But it's actually just a way to fix a very old problem. In the traditional world, if you sell a stock, the trade happens right now. But the cash doesn't actually settle for 2 days. That's called T+2.
Which feels archaic in a world where I can send an email instantly.
It is. And during those 2 days, you have what's called counterparty risk. What if the other guy goes broke before the money arrives? Atomic settlement is T+0. The swap of the asset for the payment happens simultaneously, instantly.
So I hand over the digital token, you hand over the digital cash, and it happens in the same heartbeat. No waiting.
Theoretically, yes. That is the dream.
But you mentioned a reality check earlier. Is this actually happening, or is it just a nice idea on a PowerPoint slide?
Oh, it's happening. But maybe not with the Wild West energy people expect. IOSCO found that adoption is growing, but it's still a tiny fraction of the global financial sector. And interestingly, the commercial adoption isn't happening in, exotic new assets. It's happening in the most boring places imaginable.
Which are?
Fixed income, so bonds and money market funds.
So the revolution is being televised, but it's airing on the C-SPAN of finance.
That's a perfect way to put it.
Yeah.
The casino vibe is gone. Now it's about making the back office more efficient.
Okay, let's dive into those case studies then. You mentioned bonds. I see a note here about a UBS digital bond. This seems to be the poster child for this whole evolution.
Yes, this is a fascinating example of how the old world and the new are merging. So UBS issued a bond on the SXX digital exchange in Switzerland. Now, this is a native token. It was born on the blockchain. But, and here's the kicker, it is dual listed on a traditional exchange.
Wait, hold on. If it lives on the blockchain, why list it on a regular stock market? Doesn't that sort of defeat the purpose?
You would think so.
But
But this highlights a key insight from the report. Even though the technology can settle instantly, the infrastructure links back to traditional systems because big investors prefer it. They want the familiarity. They want the liquidity.
So if you're a massive pension fund, you don't want to figure out how to use a digital wallet just to buy a bond from UBS.
Exactly. You want it to show up in your clearing account like everything else. You want it to look normal.
It's like buying an electric car but putting a fake gas tank on it so people feel comfortable.
In a way, yes. It's a bridge. And we see a similar thing with the Asian Infrastructure Investment Bank bond in Euroclear. They aren't replacing the central securities depositories, the CSDs. They're integrating the blockchain into them.
So the narrative that blockchain was going to kill the middleman, that's kind of dead.
For now, yeah. Disintermediation hasn't really happened. The middlemen are just upgrading their software.
Okay, so bonds are one thing, but let's talk about what you call the killer app right now, money market funds. Why is this specific, very boring asset class suddenly so popular?
Because of interest rates.
Hmm.
In a high interest rate environment, people want yield. Tokenized MMFs let you park your cash on-chain, earn that 4 or 5% yield, but still use the token like it's cash. You're earning yield while holding a liquid token, instead of just letting it sit in a stablecoin earning zero.
Now, I want to get technical for a second because this blew my mind when I was reading it. Let's compare BlackRock's BUIDL fund versus Franklin Templeton's. They look the same on the surface, right? But under the hood, the legal structure is completely different.
This is a crucial detail, and it's where the tokenization label gets confusing. Let's start with BlackRock's BUIDL fund. You hold tokens in your wallet. It looks like crypto, but the official legal record of ownership is still an off-chain database.
So the blockchain is just a copy, a receipt.
And essentially, yes, it's a shadow record. The real source of truth is the transfer agent's database. If there's a discrepancy, the off-chain database wins.
Okay, that feels very traditional. So how is Franklin Templeton's fund different?
In their case, the blockchain is the official record. If the blockchain says you own it, period.
That sounds much more crypto native. That's what people were promised. But then I saw a note here about something called God mode.
Yes. And this is where the crypto purists get very uncomfortable. Even though the blockchain is the official record, the transfer agent retains God mode control. If you lose your key or there's fraud, they can burn your tokens and reissue them to someone else.
Which goes completely against the whole code is law ethos. If I lose my Bitcoin key, that money is just gone. But here, Franklin Templeton can just hit undo.
They have to. For regulated financial assets, that is a feature, not a bug. Institutions cannot tolerate losing $100 million because an intern lost a USB drive. It reintroduces the intermediary, yes, but it solves the lost key anxiety that keeps big money away.
That makes sense. You need a safety net. Now, there was a third example, the SPICO EU T-bills fund. They're using public blockchains like Ethereum. What's the catch there?
The catch is a concept called settlement finality. If you're on a layer 2 network, which is built on top of Ethereum to be faster and cheaper, when is the transaction actually done? Is it when the layer 2 accepts it? Or do you have to wait for it to be verified on the main Ethereum layer 1?
And if you're moving millions, that few minutes of uncertainty is a big deal.
It's a huge deal. Banks hate that kind of uncertainty.
So we've covered the assets. Now let's look at the plumbing. The boring stuff. Repos and collateral. I saw a stat that JP Morgan has processed over $2 trillion in tokenized transactions here.
That's the number. Their platform is called Kinexes. It used to be called Onyx.
$2 trillion. That is not a pilot program. Why is this specific area so big?
Because of intraday repos. A repo is basically a pawn shop transaction for banks. You have a treasury bond, you need cash for a day. You sell the bond with an agreement to buy it back tomorrow for a little more.
Right, it's usually an overnight thing.
Exactly. But with tokenization, because settlement is instant, banks can lend and borrow for mere hours or even minutes. If you need cash at 2 p.m. but you don't get paid until 4 p.m., you do an intraday repo for 2 hours.
So you aren't paying interest for 24 hours when you only needed it for 2?
Precisely. It frees up billions in capital that would otherwise be sitting there just in case. Broadridge has a similar platform that saves 50 to 60% in costs. This is the efficiency play. It isn't sexy, but it saves banks a fortune.
It's the unsexy plumbing that keeps the house from flooding. But there's a catch, isn't there? The data. A blockchain is a closed loop. It doesn't know the price of gold unless someone tells it.
This brings us to the Oracle problem, which RWA.io discusses a lot. An oracle is the bridge that feeds real-world data to the blockchain.
And bridges can collapse.
Exactly. If an oracle is hacked or just feeds bad data, the smart contract doesn't know. It just executes. If the oracle says gold is worth $10, the contract sells your gold for $10.
So that creates a massive central point of failure in a system that's supposed to be decentralized.
Yes. For real-world assets, reliable data is everything. Who tells the blockchain what the rent collection was? Who inputs the building's valuation? If that's corrupted, the whole thing falls apart.
Which leads us to the broader risks. IOSCO labeled this section "Same Business, New Headaches," which I love. We've talked about legal ambiguity. But what about these things called stock tokens?
Oh, this is a murky area. You might see Apple stock tokens on a crypto exchange and think you're buying a share of Apple. But IOSCO warns that usually you aren't.
So what are you buying?
You're likely buying a derivative, a contract with the exchange that promises to pay you based on Apple's price. The exchange might hold the real share, or it might not. You probably don't have voting rights.
I see. Then there's the island problem. All these banks are building their own blockchains. Do they talk to each other?
Currently, not really. That's fragmentation. Liquidity gets trapped on these islands. If I have a tokenized bond on Ledger A, I can't easily use it as collateral on Ledger B.
It feels like we're rebuilding the siloed intranets of the 1980s before the internet connected them all.
There's a risk of that. But there are solutions emerging. The Canton Network is trying to build a network of networks. And there's an initiative called Global Layer 1 trying to create a shared infrastructure. But we're kind of retrofitting it after the fact.
I want to circle back to one big technical risk: settlement assets. If I swap a tokenized bond for cash instantly, what is the cash?
That is the trillion-dollar question. You can't settle instantly if you're waiting for a wire transfer. You need tokenized cash.
Like stablecoins, USDC.
Stablecoins are the popular answer in the crypto world, but regulators are very nervous about them. They involve credit risk. If the stablecoin issuer goes bust, your cash is gone.
So what do the regulators want?
They want central bank money on the chain.
Yeah.
CBDCs, central bank digital currencies, or tokenized commercial bank deposits. They want the cash leg of the trade to be as safe as the asset leg.
Speaking of regulators, let's talk about the rules. The President's Working Group put out a report in 2025. What's the vibe?
The vibe is clarity. The guiding principle from IOSCO is same activity, same risk, same regulatory outcome.
Meaning?
Technology is neutral. If it looks like a bond and acts like a bond, it follows bond rules. It doesn't matter if it's on a blockchain or a napkin. You don't get a free pass for using tech.
And in the U.S., the big fight has always been the turf war between the SEC and the CFTC.
The 2025 report tries to draw those lines. If it's a security, it's the SEC. If it's a commodity or derivative, it's the CFTC. They're trying to move away from regulation by enforcement, just suing people, toward clear rules. And they're creating sandboxes.
I keep hearing this term, regulatory sandboxes.
Think of it as a controlled playground. Regulators let companies experiment with these tokens in a limited environment, with real money, but with strict oversight. It allows innovation without putting the whole financial system at risk.
Okay, so let's look down the road. Where is this all going? What are the numbers saying?
The growth projections are all over the place, which tells you nobody really knows. McKinsey is predicting $2 trillion in tokenized assets by 2030, which is a lot, but still modest.
But then you have others who are way more bullish.
Right. Standard Chartered and Synpulse are predicting up to $30.1 trillion by 2034.
That is a massive spread. That's the difference between a niche industry and eating the entire financial world.
It is. But if you look at the immediate data, RWA.io reported a huge jump in the secondary market just in early 2025, from 10 billion to 18 billion in just a few months. So the curve is pointing up. The momentum is real.
But coming back to our mission, is this changing why we trade or just how?
I think the final takeaway is that the dream of a completely decentralized, intermediary-free financial system, the crypto dream, that hasn't really happened here. Instead, the traditional intermediaries are adopting the tech to make their systems better.
So the banks won.
In a way, yes. Tokenization is solving real inefficiencies: fees, speed, collateral mobility. But the banks are still very much in charge. They aren't being replaced, they're being upgraded.
It reminds me of the internet again. We thought it would democratize everything, but eventually the big companies figured out how to use it best.
That's a fair analogy. The infrastructure is changing, but the players remain largely the same.
So here's where it's really interesting for you, the listener. If the ultimate goal of all of this is seamless efficiency, will we reach a point where tokenization just becomes invisible?
That is the provocative thought, isn't it?
Think about it. In 10 years, if your bank account settles instantly and your stock trade costs zero fees, will you even care that it's running on a blockchain? Or will tokenization just be the silent software update that finally fixed the plumbing of global finance?
If they do it right, you shouldn't know it's there at all. It should just work.
And on that note, we will leave you to ponder the invisible future of your money. Thanks for diving deep with us.
Thank you.